For more than a decade, Tesla has been valued less like a car company and more like a technology platform in waiting. Now, with its renewed push toward robotaxis, the company is trying to turn that long-standing narrative into a concrete business reality. Tesla's robotaxi strategy is not just about autonomous vehicles. It is about reshaping revenue models, redefining vehicle ownership, and altering competitive dynamics across transportation, logistics, and urban mobility. At the core of Tesla's robotaxi push is a simple but disruptive idea: cars that earn money instead of depreciating. Tesla has repeatedly framed autonomous driving as the key to transforming vehicles from idle assets into revenue-generating machines. If successful, this would fundamentally change how consumers, investors, and competitors think about automobiles. A Tesla would no longer be just a product sold once, but a node in a recurring service network. From a business strategy perspective, Tesla's approach differs sharply from many rivals. Instead of building a centralized fleet owned by the company, Tesla envisions a distributed robotaxi network made up of customer-owned vehicles. Owners could choose to add their cars to the network when not in use, earning a share of ride revenue. Tesla, in turn, would take a platform fee, similar to how app marketplaces operate. This asset-light model allows Tesla to scale without carrying the full capital burden of fleet ownership. This strategy also aligns with Tesla's long-term margin ambitions. Vehicle margins are cyclical and vulnerable to price competition, incentives, and economic slowdowns. A robotaxi network introduces recurring, software-driven revenue with potentially higher margins. Even modest per-ride fees, multiplied across millions of trips, could materially alter Tesla's financial profile. This is a key reason investors continue to view autonomy as central to Tesla's valuation story. Tesla's vertical integration plays a critical role in this push. The company controls vehicle hardware, onboard computing, software updates, and data collection. Each mile driven feeds real-world data back into Tesla's autonomous system, strengthening its learning loop. Unlike competitors that rely heavily on geo-fenced environments or expensive sensor stacks, Tesla is betting that scale and data volume can compensate for a more generalized approach to autonomy. However, this strategy carries significant execution risk. Achieving reliable, fully autonomous driving at scale remains a complex challenge. Edge cases, regulatory scrutiny, and public trust all represent obstacles. From a business standpoint, delays in autonomy deployment could strain Tesla's credibility and force continued reliance on traditional vehicle sales in an increasingly competitive EV market. The robo-taxi push also has implications for pricing strategy. If Tesla expects vehicles to generate future service income, it can justify aggressive upfront pricing or even subsidize vehicle costs. This could intensify pressure on competitors that lack comparable software revenue ambitions. In effect, robo-taxis allow Tesla to compete on vehicle price while still targeting long-term profitability through services. For the broader transportation market, Tesla's robotaxi strategy threatens existing ride-hailing models. Traditional platforms rely on human drivers, face labor constraints, and operate on thin margins. A successful autonomous network removes labor costs from the equation and enables 24-hour utilization. This could compress pricing across the ride-hailing industry and force incumbents to rethink their economics. Public transit and urban planning could also feel indirect effects. If robotaxis become widely available and cost-competitive, demand for personal car ownership could decline in dense areas. Cities may need to adapt infrastructure, parking policies, and traffic management systems. Retailers, real estate developers, and logistics firms would all be affected by changes in how people and goods move through cities. Regulation remains one of the most important variables shaping market impact. Autonomous driving approval is fragmented across states and municipalities, creating a patchwork rollout environment. Tesla's strategy depends on navigating these regulatory frameworks faster than competitors while maintaining safety performance. Any high-profile failures could slow adoption and trigger stricter oversight, affecting not just Tesla, but the entire sector. The robo-taxi push also reshapes Tesla's internal priorities. Software reliability, AI training, and system redundancy become as critical as manufacturing efficiency. Talent investment shifts toward machine learning and systems engineering rather than purely automotive disciplines. Over time, this could further blur the line between Tesla and traditional automakers, positioning it closer to a mobility technology company. For competitors, Tesla's strategy raises the stakes. Automakers must decide whether to pursue autonomy independently, partner with technology firms, or avoid the space entirely. Each option carries trade-offs in control, capital requirements, and long-term relevance. Tesla's willingness to bet heavily on robotaxis pressures the entire industry to clarify its own vision of the future. Ultimately, Tesla's robotaxi push is not just a product initiative. It is a strategic attempt to redefine where value is created in transportation. Success would mean shifting revenue from one-time vehicle sales to ongoing mobility services, changing competitive dynamics across industries. Failure would reinforce the limits of autonomy and refocus attention on traditional automotive fundamentals. Either way, the market impact is already visible. Investor expectations, competitor strategies, regulatory debates, and consumer perceptions are all being shaped by Tesla's robotaxi ambition. Whether robotaxis arrive sooner or later, Tesla has made one thing clear. The future it is building is not just about selling cars, but about controlling how mobility itself is delivered.